Hi again, it's Rafi here, and we're going to go over education, mortgage, and some multi-goals output today. So slide over to this tab, okay, and we're continuing with our existing persona. Our first child is ambitious, is looking for $20,000 a year to be funded out of the RESP or out of their education savings in general. And we do achieve that goal based on the previous inputs that we made. These would be the contributions that we make and the capture of grant. This graph would represent the capacity to save over time and the contribution towards RESP. So this is the entire savings capacity. This is the contribution made. The blue would represent contribution or savings capacity going to your other goals. This would be the withdrawals from savings to education. And what I've done is this is $20,000 a year for 5.5 years. We're estimating this academic career to last, probably some grad school. And what we've done is we've assumed that this ambitious child is actually going to have an on-campus or off-campus job of $10,000 a year, which is going to trigger some tax. So in year one, and we've given them a raise of 1% a year. So in year one, school would start in September, would represent one semester. So $5,000 in income. And then the full year would be $10,000 plus that 1% raise that continues over time. Now our RESP optimizers calculate all sources of income, all taxes, and we take into account which withdrawals from the RESP account are taxable. The capital withdrawal is not, but the grant and the accumulated income are. So if we zoom in a little bit, you can see towards the end, there's quite a bit of tax paid. And we're minimizing tax, but not eliminating tax. And the income is well over $20,000 a year, and the taxable income would be well above and beyond the basic personal exemption, or the basic personal amount of about $13,200 and change in 2020. And then we're drawing down the account balance of child one towards zero. Looking at child two was a little less ambitious, only needed $5,000 a year in income. So that will be well below the taxable threshold. So we make these contributions. We collect this much in grant. We're taking into account the existing balances that are there. These are the withdrawals. There's nothing taxable, no red. So we've succeeded in eliminating taxation. The RSP account is drawn down towards zero. You can look at this in Tableau form, or what we call Tableau or table form as well. Again, each child, each year, each sub account within your capital, the CESG, and then the gains and income into the account, and then just a summary again of contribution over time per child, and these are the last years of the withdrawals. So that's our analysis of RESP. And one more note, you can download to CSV. You can download all of our analytics to CSV. Just look for this download RESP planner download button. We'll go to mortgage now. We are allocating quite a bit of our capacity to save towards the mortgage. This was a 25-year fixed mortgage. We started it in 2020 just for ease. And notice that with all of the principal early pay down that we're making, you actually pay the mortgage down 7 years early. So if the advisor was looking at different capacities or different allocations to goals based on capacities to save, we could play with how early you may or may not want to pay your mortgage down. Again, we can compare more than one schedule, and on this side, there'll be a download to CSV as well. And you can download all of your cash flows. Again, funded from what we call capacity to save, and then multiplied by the allocation towards this goal, and then hierarchically defined by the waterfall that we built within the assumption builder. Okay, one more tab that we'll go look at now quickly. These are sort of our calls to action. This graph on the left, think of it as sources and uses of income. Okay, and again, this is a single individual, and we're going to show a married individual how this all changes in upcoming videos. But right now, this is a single individual who we can isolate in on sources of income. They had a $12,000 non-registered cash flow. That was, and then $150,000 in income. We can look at all of the different expenses. So 65,000, these are the total taxes paid, mortgage, TFSA, RRSP, a little harder to see, but the mortgage lump sum for that year, CPP, RESP, and EI. And we can do this for every year. So if you wanted to look roughly 10 years forward to see what that might look like in terms of incomes and expenses, we factored in all your raises and other things that we've defined. So your different sources of income, your salary of $174,000 and change, your RRSP refund, and a non-registered account cash flow of just under $6,000. We can drill into expenses as well and go around the wheel item by item, year by year. This is more of our calls to action. And again, the single individual, so retirement 2 for partner 2 is kind of irrelevant, and we'll get back to this diagram in a spousal scenario, but we could look at retirement for partner 1 and see all the different cash flows for that year. We can look at mortgage, your regular payments, your lump sum payments. Looking at education, we made a $908 contribution here and a $336 contribution for child 2. And around for retirement, these would be the various cash flows. And again, we can show this for every year. So going out, let's say, till 2036. It'll take a sec. And here they are. You can drill down again. And finally, we show goal scores. And this is a good saver, a good earner, and we've allocated properly towards our goals. So education, we would give 100%. You may want to oversave a little bit, go more towards 120, and certainly towards retirement also, we would score that 100. So that's it for now. Thanks for joining this video, and we'll talk to you soon again. Have a great day.